Here is the trap that almost everyone falls into when they finally save a substantial chunk of money. Let's say you just hit $50,000. You worked your ass off for it, you sacrificed, and now you are finally ready to invest it. So you open your brokerage app, you pull up the S&P 500, and you see a chart that looks like a straight line pointing up. You switch over to the financial news and every single headline is screaming the exact same thing. Markets hit new all-time highs. Are we in a bubble? Looming recession on the horizon. And right there, your survival instinct kicks in. You think, well, I'm not an idiot. I'm not going to be the sucker who puts my hard-earned money in at the absolute peak right before the whole thing comes crashing down, right? So you make a choice. You decide to hold that $50,000 in cash. You tell yourself you are being strategic. You are going to sit patiently on the sidelines, wait for the market to drop 20%, and then you'll swoop in and buy the dip like a Wall Street genius. It feels smart. It feels safe. It feels like you are in control. But here's the brutal truth. That specific decision, waiting on the sidelines for the perfect time to invest, is statistically the most expensive mistake you will ever make in your financial life. My name is Max, and today we are going to look at the cold, hard math of why trying to outsmart the stock market is actually destroying your wealth. Because the data shows that the people who sit in cash waiting for a crash don't actually protect their money, they just slowly lose it in a way that doesn't trigger a panic alarm. Let's talk about the illusion of safety. Let's talk about why we do this. Why does sitting in cash feel so good? Because it gives you the illusion of control. When your money is sitting in a bank account, it doesn't fluctuate. You check your banking app on Tuesday, it says $50,000. You check it on Friday, it says $50,000. It doesn't drop 2% because some CEO tweeted something stupid or because the Federal Reserve changed interest rates. Your brain loves this stability. Human beings are hardwired for survival, and volatility feels like a threat to our survival. So when you refuse to put your money into the market, your brain rewards you. It tells you that you are safe. It tells you that you are a master strategist who is playing it cool while everyone else takes risks. But here's the problem with that feeling. It is a complete lie. People think cash is a risk-free asset. It isn't. Cash is a melting ice cube. Every single day that your $50,000 sits in a checking account or a standard low-yield savings account, it is actively losing value. Inflation is the invisible thief that quietly steals your purchasing power while you are sleeping. If inflation averages just 3% a year, holding $50,000 in cash costs you $1,500 annually in real buying power. You don't get a notification on your phone when it happens, but the money is gone just the same. You aren't actually avoiding risk by sitting on the sidelines. You are just trading the temporary risk of market volatility for the 100% guaranteed mathematical certainty of losing your wealth to inflation. You didn't protect your money from a crash. You just put it on a slow leak. But what about the news? What about the fact that the market is at an all-time high? This is where our brains completely betray us. We take the laws of physics and try to apply them to finance. We look at a chart that has gone straight up and we think, what goes up must come down, like a baseball thrown into the air. But the stock market is not a baseball. It is not governed by gravity. The stock market is a measurement of human innovation, corporate earnings, and economic growth. Because population grows, technology improves, and companies become more efficient, the market should go up over time. Therefore, all-time highs are not anomalies. They are a feature of a functioning economy. In fact, the data completely destroys the waiting for a drop strategy. JP Morgan looked at decades of market history. If you invested your money on a random day, your average one-year return was around 9.7%. But if you invested your money on the exact day the market hit an all-time high, your average one-year return was actually higher, around 10.3%. The same is true for 3-year and 5-year returns. Momentum is real. Let me show you how this plays out in real life. Let's look at two investors, Market Timer Tom and Steady Sarah. In early 2024, the market hit a record high. Both Tom and Sarah had $50,000 in cash.
Tom read a headline about a looming recession. He said, "I'm going to be smart. I'll keep my cash and wait for the market to drop 20%. Sarah ignored the news. She knew she couldn't predict the future, so she just bought $50,000 worth of an S&P 500 index fund right at the all-time high. What happened? The massive crash never came. Instead, the market just kept breaking its own records. By holding out, Tom missed a massive run-up. Today, Sarah's portfolio has grown significantly, while Tom is still sitting in cash reading the exact same doomsday articles. Here is the tragic part for Tom. Even if the market crashes 20% tomorrow, it will only fall back to the price Sarah originally bought in at. Tom waited years just to buy at Sarah's starting line while missing out on all the dividends along the way. But let's pretend you're right. Let's pretend you hold your $50,000 in cash and tomorrow the market actually drops 20%. Do you really think you're going to buy? Think about what the world looks like when the market drops 20%. Employment is spiking. Companies are going bankrupt. Every news channel is screaming that this is the next Great Depression. You aren't going to buy the dip. You are going to be terrified. You are going to say, "I wait until it drops 30%. And then the market will rebound while you're still waiting."
And this brings us to the brutal math of missing out. JP Morgan Asset Management does a study on this every single year, and the numbers are terrifying. Let's say you invested $10,000 in the S&P 500 and just left it alone for 20 years. Your money would have grown to over $64,000. But what if you tried to time the market? What if you jumped in and out, and because of that, you missed just the 10 best single days over those 2 entire decades? Your return drops to $29,000. Missing just 10 days out of 5,000 trading days cuts your wealth by more than half. And here is the ultimate punchline. Do you know when those best days happen? They don't happen during bull markets when everyone is happy. Historically, 7 of the 10 best days in the market happen within exactly 2 weeks of the 10 worst days. The massive rebounds happen immediately after the massive crashes. The people who sell in a panic or the people who sit in cash waiting for the dust to settle, they miss the rebound every single time. You cannot successfully time the market. No one can. Not you, not your uncle, and not the guys on Wall Street in the $1,000 suits. So what do you actually do with that $50,000? If taking that entire lump sum and throwing it into the market tomorrow morning makes you feel physically sick, I get it. You don't have to do that. There is a mechanical solution to this emotional problem. It is called dollar cost averaging, or DCA. It is the ultimate antidote to the waiting for a crash trap. Instead of trying to guess the perfect day to jump into the pool, you just slowly walk down the steps. Here's the exact playbook. Take that $50,000 and divide it by 10. That gives you $5,000. Now you go into your brokerage account and you set up an automated recurring transfer. On the first of every single month, it automatically buys $5,000 worth of a broad market index fund like the S&P 500. You do this for 10 months. You do not look at the financial news. You do not check if the market is at a new all-time high. You do not check if Jim Cramer is crying on television. The machine just buys. Look at how this shifts your psychology. If the market goes up next month, great. The money you already invested is growing. But if the market goes down next month, even better. Your next automated $5,000 purchase just bought shares at a massive discount. You are literally buying the dip automatically without ever having to predict when the dip happens. What this strategy does is remove the 2 most destructive forces in investing: fear and ego. You are no longer paralyzed by fear, and you are no longer letting your ego trick you into thinking you are smarter than millions of professional algorithms. You are just executing a plan. Now, let me be completely honest with you. Will the market crash again? Absolutely. Yes, it will. The stock market experiencing a 10% or 20% correction is not a glitch in the matrix. It is a normal, healthy part of the economic cycle. It's like winter. You know winter is coming, but you don't stop building your house in July just because it's going to snow in December. The legendary investor Peter Lynch once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves." Think about that. The preparation for the crash costs you more than the actual crash. Because while you are sitting in cash, waiting for the perfect day when the stars align and the news is good and the prices are low, the world is passing you by. Companies are inventing new technologies, consumers are buying products, and wealth is being generated. There is one rule of wealth building that has never been broken, and it is the only rule you need to remember from this entire video. Time in the market always beats timing the market. So stop waiting for the perfect moment. The perfect moment was 10 years ago. The second best moment is today. Take your money, pick a simple index fund, set up your automated purchases, and get off the sidelines. My name's Max. If this video helped you stop second-guessing yourself and finally get your money working, hit that subscribe button. We are going to build real wealth on this channel, and we are going to do it without the stress. I'll see you in the next one.